Ed Denny, look forward to
to
this
have
one.
you on
Thank
this,
you.
unsettled end of the week, I think we can say. What's your
Sure.
opinion of it?
Well, yesterday it was largely because of.
By the way, let me say this about this whole market sell-off, okay? I was watching the action. This was a very orderly sell-off. And that's another reason, if this sell-off scared you, got to reassess your situation, because I can just tell you as an experienced investor who's been doing this a long time, this was a very orderly sell-off. There was no panic out there. There was no people freaking out and just selling stocks at any price. I didn't see any of that activity. When you get into a real panicked market, you're going to see 7, 10, 12% moves down for a lot of stocks. And I didn't see that. I saw a lot of 3, 4, and 5% moves down for stocks. That's nothing. That's nothing, man. 3, 4, 5% moves down. I was kind of waiting. I was interested to see the last hour of trading specifically, because the last hour of trading will tell you a lot about how worried the market actually is or whatever. In the last hour of trading on Friday, pretty chill actually. The market did not just fall apart, because when you're in a panicked market, that last hour of trade can feel very panicky. And you could see, for instance, the Dow was down about 750 points roughly going into that last hour. If you were in a really panicked market, the Dow would have finished down over 1,000 points. You would have saw another big flush in that last hour of trading. It didn't. The market ended up finishing down 750 or somewhere around there roughly. And the S&P 500 going in that last hour, the Russell 2000, the NASDAQ, the Qs, everything was right around. It just kind of it just chilled out. And so that's a market that's very orderly, which is another reason why I'm not that worried about the big tech for the next 9 months.
It was largely because of Walmart's guidance that kind of spooked everybody about the outlook for the consumers. Today we've got the United Health issue. And so I think you got a couple of very expensive stocks that are taking a little bit of a re-rating here. I mean, that's what Walmart's doing. And
that's true.
They have a forward PE of 38.
Yeah.
I think the consumer's still okay. I'm looking at weekly data like initial unemployment claims, and it looks like the jobs are still there, even with all the craziness going on in Washington. And I'm also looking at the weekly retail sales series, and that's up 5% on a year-over-year basis. So I'm not particularly concerned that we're suddenly looking at a correction or a bear market. Bear markets are caused by recessions. I don't see a recession, and corrections are caused by fears of a recession, and maybe the tariff thing is doing it, but I don't think so.
Some look at the divergence between discretionary and staples. I don't know if we can throw, a chart up that shows what I'm talking about specifically.
Yeah, the only thing that could scare me about big tech not doing well the next 9 months, and this is the only thing, the Fed's going to do what the Fed's going to do. That doesn't scare me. The only thing that scares me to say big tech could have trouble the next 9 months, and this is the only thing, is if you actually got a legit recession the next 9 months. Let's say they're cutting all these jobs, these federal jobs, and that, along with the immigration stuff and deportations, and let's say just all that together just accumulated in this, somehow they caused a recession, right? And that, along with some other factors, and a loss of confidence even further from the consumer, and let's say prices stay a little sticky, so you get some stagflationary environment. That's the only thing. But even then, I think big tech still sets up pretty darn well, because of where a lot of those stocks are valued in P's in the 20s for many of them. It's not like they're going in with some crazy valuations. If those stocks were all had P's of the 40s or 50s or something, I'd feel very differently about that, right? But that's just not the reality. Look at the forward P on all those stocks other than maybe Tesla, and they all look actually pretty darn compelling.
But the trend has not been great in terms of discretionary is the worst.
They make so much money that, okay, they make less money? Okay. They still make so much dang money, it's ridiculous. It's insane.
The discretionary is the worst of this year, and there's been a lot of money going into staples. Concerning to some, not you?
Well, I think it's a short-term issue here in terms of the fundamentals. The fundamentals still look pretty good across the board for consumer spending. Yeah, they're spending on consumer staples, but I've noticed that even with the weakness in home sales, furniture sales have really been very strong over the past several months. Car sales have been volatile, but they were very strong at the end of last year. A lot of discounting, so there was some weakness in January. Consumers are definitely spending on durable goods now, and that was something that they stopped doing for a while after they went on a buying binge following the pandemic. So from a fundamental perspective, I'm not particularly worried.
I mean, I played earlier a soundbite from the billionaire investor, owner of the New York Mets, Steve Cohen, who's down in Miami, who talked about how he's feeling less confident about the economy for a variety of reasons that are on the mind of a lot of investors, including the likes of Citadel's Ken Griffin, who talked about tariffs, our alliances globally, and just the uncertainty that it has caused in their minds, perhaps unnecessarily. And I'm wondering how you think the average investor should think about that.
Well, life doesn't come with any guarantees, and there's always uncertainty. And I think now with this regime change between Biden and Trump, we certainly have uncertainty. But that seems to be the nature of our political cycle. We go from, one president to the next, and before you know it, we have a radical change in policy making. And I think it takes a while for all this to settle down.
Yes.
But certainly there's concerns about tariffs. There's concerns about getting a budget together. And then, of course, the whole geopolitical situation looks pretty messy right now, clearly. But at the end of the day, the stock market is driven by earnings and valuation. Valuations are stretched, so we're seeing some re-rating to the downside. Even the Magnificent Seven have at least stopped going up on a valuation basis. But the earnings picture still looks really bright to me. And I think that the AI, robotics, humanoid, technology-led productivity boom is still very much with us. And I think we're going to continue to see that in better than expected profit margins and better than expected earnings. I think earnings are going to drive this market for the rest of the decade.
The rest of the decade. Oh, man. And something I appreciate that Ed Yardendy mentioned there, and I do think that's important, is a decade, right? In thinking longer term in regards to these things. Because, listen, man, tariffs are going to be here, tariffs are going to be gone. Taxes are going to go up, taxes are going to go down. Presidents come, presidents go. All this stuff, it is what it is. It's short-term stuff that everybody freaks out and worries about, and it's worth worrying about, I guess, in the short term. But the long term, it means nothing. The bottom line is you got to build positions in great companies that you love for the long term and focus on that name of the game, right?
Hey, it's Jeremy. I hope you really enjoyed that clip here today. Listen, there are three main areas a long-term investor has to understand. You have to understand financial statements, income statements, balance sheets, cash flows. You have to understand and master portfolio management. And you have to have the ability to project what is possible for companies in the coming years. Bearish scenarios, bullish scenarios. All these skills can be learned, and that's the good news. And I'm still just a regular guy who's out here. I just have a lot of passion for the market. I've learned a lot over the last 15 years. I had a tremendous amount of success, and I have a dedication to teaching people everything I have learned in the past 15 years. If I can do it, you can do it too. You can learn all that's required to become a great investor in my private group. The application is going to be down there in the description area. You can click on that, fill out an application, join us in the private group, get access to all my best course curriculums, teaching you everything that I got in my head, and you get ability to join our 6-figure, 7-figure Hall of Fame. We have such a tremendous Discord. It is incredible. So once again, description area down there, there's a link. You can apply to join my private group in there.
If you're looking, what we're looking at here is a fund manager survey and how much cash they're holding. The fund managers are basically all in on this market. This was the most recent reading here. Assets under management as a percent cash, they're very all in this market, okay? That is not super bullish when these fund managers are basically pretty much all in the market, right? That makes it hard to get a lot of upside in regards to stocks, right? Now, the additional thing is, because some people might read this and they say, oh, this is very bearish. This means we're going to crash. No, not so fast. And here's why. There's been plenty of time periods in the past where fund managers got down to very low levels of cash, and it was actually a great time to be an investor in the market over the next few years. Look at this time. This is the end of 2010 going into 2011. I can tell you, you could have looked at this and said, oh, this is very bearish for the stock market. Listen, it was a great time to be buying stocks. Look at right here. This is the end of 2012 going into 2013, right? Fund managers got very low on cash. I can tell you there was a lot of fun to be had over the next few years. There was a lot of money to be made in the stock market, right? Fund managers got very low on cash here. There's still a lot of money to be made over the last few years, is there not, right? So the only real tell in this chart, in my opinion, is when fund managers get over 5%, when fund managers get over 5% cash, that is a time that usually makes sense to be low in the boat on stocks. So for instance, December 2008, right? Late 2008, great time to be low in the boat on stocks. Fund managers were over 5% cash. Right here, they went over 5% cash in 2011, 2012. Great time to be low in stocks. October 2016, great time to be low in stocks. And even prior to that, right? Obviously here, April 2020, great time to be low in stocks. In October 2022, great time to be low in stocks. So whenever they go over 5%, and especially if they start going to like 6% or so, great time to be low in stocks. Great time. So do keep that in mind in regards to that chart. But still, once again, I wouldn't read it as like super bullish, right? Definitely not. I'll get super bullish when we go over 5% cash, and especially over 6% when it comes to those fund managers, right? Additionally, it's not just fund managers are all in the market. Retail's all in the market. Look at margin debt levels. $937 billion, approaching close to $1 trillion of margin debt. What the hell is retail doing? Like, what are they doing? Loading up on margin debt with these super high interest rates? I mean, it's not cheap to take out margin. That's the first thing. Like, you need to make like 8 or 9% minimum. I think actually a lot of these companies are charging like 10% margin rates right now. So you need to get like a 10% return just to pay off your margin. That's crazy, man. Your margin interest, that is. Not to pay off your margin interest. Like, what is retail doing? Like, I'm very disappointed that they're loading the boat on margin. And I'm like, this is not the time to be doing that. Like, first off, it's never the time to be loading the boat on margin, right? But especially not when you're coming off of a nearly 2.5-year bull cycle. Remember, we bottomed out this market around October of 2022, right? And so to be loading up on margin, you're way late to the game. And at these sorts of margin rates, and keep this in mind, we are now at all-time highs in terms of margin outstanding, right? 937 billion. You know, the old highest record was back here in October 2021. Retail, $935 billion of margin debt. Now, remember, back here, in October 2021, remember, margin interest rates were on the floor. Like, you could get margin loans at like 3% interest rates, 4%, 5% were very customary at that time. So it was very cheap. Now it's extremely expensive to take out margin interest. And remember what happened shortly after we hit that all-time high for margin debt outstanding from the retail crowd, right? What happened? Bang, we got hammered, right? And then we kept getting hammered in 2022. So that's not a guarantee that we're going to get hammered or something like, but it's not a great sign. It's not a sign you would look at to say, oh, I feel great about the market. When you want to feel great about the market and loading up on stocks, when margin debt gets very low, because that basically means people are scared. They don't want any part of the market, right? So for instance, look at like right here. Look at like November 2022. Got all the way down to $643 billion of margin debt outstanding. And that was from $935 billion, just a year prior, right? Look at this. December 2022, got all the way down to $606 billion margin. So very low number, extremely low number. So you basically cut off over $300 billion of margin debt. It was very healthy, right? And that was a good telltale sign of like, load the boat on stocks, right? So when this number gets extraordinarily high, start to be more fearful. And when this number is very, very low, be very, very optimistic, right? I mean, look at back here. This was May 2020, right? That was the Rona shutdowns. But it was also a great time to be bullish on the market because the market bottomed in March, April of 2020, and then went through an incredible bull cycle that, look at where the market was at in March of 2020. Look at where the market was at in April of 2020. Look where the stock market is today. Look at where all the most popular stocks were in March and April of 2020. Look at them today. So you can make an argument that that was a telltale sign. Like, wow, we went under $500 billion of margin debt outstanding. Load the boat, okay?
Hey, it's Jeremy. I hope you really enjoyed that clip here today. Listen, there are three main areas a long-term investor has to understand. You have to understand financial statements, income statements, balance sheets, cash flows. You have to understand and master portfolio management. And you have to have the ability to project what is possible for companies in the coming years. Bearish scenarios, bullish scenarios. All these skills can be learned, and that's the good news. And I'm still just a regular guy who's out here. I just have a lot of passion for the market. I've learned a lot over the last 15 years. I had a tremendous amount of success, and I have a dedication to teaching people everything I have learned in the past 15 years. If I can do it, you can do it too. You can learn all that's required to become a great investor in my private group. The application is going to be down there in the description area. You can click on that, fill out an application, join us in the private group, get access to all my best course curriculums, teaching you everything that I got in my head, and you get ability to join our 6-figure, 7-figure Hall of Fame. We have such a tremendous Discord. It is incredible. So once again, description area down there, there's a link. You can apply to join my private group in there.
Now, there's a worry coming into the stock market. I'm seeing it more and more, and I'm starting to hear it talked about more and more. And it's called stagflation, right? Now, stagflation is typically categorized as an economic cycle which has slow growth, a high unemployment rate, and high inflation, right? Now, I don't think there's really worries about like a 10-10. What is a 10-10? A 10-10 is a stagflation environment in which you got like 10% unemployment and like 10% CPI, right? That's a disaster, and that's something you could look back at kind of late 70s, early 80s. We had actually that type of dynamic where unemployment was like 10% plus and then inflation rates were 10% plus. We don't have that sort of worry, but I do believe there's kind of like a worry about a 5-5. A 5-5 would be like unemployment goes to 5-something% and we have like a CPI of 5-something%, right? Which would make it very tough to get much growth in the economy and a much growth in earnings of companies, unless they're just some sort of incredible company that just has sky high growth rates. And so I think there's worries about like a tame version of stagflation really starting to creep in that could really affect the economy in the second half of 2025 and into 2026, which is, I think, a serious thing to consider. I think that's definitely a possibility, right? Now, with that being said, let's imagine for a moment, I'm over here on the side of this road here, okay? And I'm building my hut, and I have all my building materials there, and I'm building this hut. So, it can help me stay dry when the big storms come and tornadoes come, and I can stay safe, right? And so there's just a big field, and I'm just building my hut here, right? But then when I see a storm approaching, right? There's a big, massive storm there. What should I do? Here are my options, right? I could try to outrun the storm, which good luck to me outrunning a storm, because the last time I checked, storms could move a lot faster than a human could over time, unless a professional marathon runner, which even if that's the situation, I still don't think I'm going to outrun a tornado. My other option is I could just lay there in the grass, right? Or I could keep building my hut. What should I do? I think it would make the most sense to keep building my hut, right? That's the same thing in the stock market. You're going to have these storms come all the time. It's not like it ends. Right now, what are our storms? Well, we got a lot of federal jobs being cut right now. What's that going to do to the economy? In the short term, probably not good things. Long term, it might be a great thing, but short term, I don't think it's a good thing. Additionally, right, tariffs coming, like what's that going to do to inflation rate? Like we have a lot of storm clouds out there, worries about stagflation and what that's going to do, right? And if you start cutting how much the government's spending with all these companies, do companies have to start laying off more people? Like it's a whole chain of events, right? Dominoes falling the whole wrong way. So we could look at all those storms and say, you know what? We're not going to do anything. We're just going to lay down. Good luck. We could say we're going to try to outrun the storm. Good luck. You're not going to outrun the storm anyways. The storm's coming, right? Or might come. It makes the most sense to keep building. And so that's what I do with my portfolio. I keep building and I keep building the portfolio regardless if the storm clouds come or not, because at the end of the day, there's going to be new storm clouds next year. I want you to understand that. And there's going to be new storm clouds in 2027. There's going to be new storm clouds in 2028. It never ends. It's just different. It's just different storm clouds, okay? But what you're going to find many times is the storm clouds never come to you. Like you keep building your hut. I'm building my hut there. I'm like, like, shoot, I got to build this hut as fast as possible. But what I end up finding is like, oh, the storm clouds never really hit me. The tornado that looked like it was coming, it actually diverted and actually went over there. Never had to hit that tornado, right? But the moral of the story is, if the tornado does hit, right, I'd rather be in my hut I try to build as much as possible versus just out here laying in the grass or trying to run away from it and the storm sucks me up and throws me around like the cow in the Twister movie. Remember that, right? But more than likely, the sun's going to come out and it's going to be a bright day and we're going to have worried about whatever we worried about, and then it's going to pass, and then we're going to be like, oh, what? Wow, the storm never even actually hit us. We thought it was going to be like, oh my gosh, all this stuff in it. No. Okay. Next up here, when will I actually get scared of a crash? I think that's an important subject, right? A few situations could actually get me scared that the tornado's coming and it's going to tear off the roof, right? One is if stagflation actually became a true reality. We don't have stagflation yet, but if it did actually start to hit second half of 2025, something like that, or even like over the summer, that's scary, right? Because you don't know how long you're going to be in that stagflationary episode. Does it last just a quarter or two? Or are we talking 2 or 3 years? 2 or 3 years of stagflation would be really painful and really dramatic. I don't know if that's going to happen, but that would definitely be something to be concerned about, right? Another situation is we've already seen CPI, the inflation rate, start to go up. If it kept going up and up and up and up and up, quarter after quarter for a while, that would be scary, right? That would definitely scare me. Additionally, this is what we put out to the private stock group, our investor report each week to all the private stock group members, going through a lot of data. I want to show you something that's a little worrisome here. Look at the consumer sentiment. Came in at 64.7 in February. That was down 15.9% year over year. And keep in mind, a year ago, consumer sentiment still wasn't even a good number. So consumer sentiment's been bad for the last several years, and it remains bad, right? And that's even with the change of administration and, the excitement that brought. Still, consumer sentiment is not good. Because you would have thought, because here's the thing, consumer sentiment was actually really good under Trump 1.0 prior to Rona, essentially. If you look at where consumer sentiment was 2017, 18, 19, consumer sentiment was actually really good. So I think a lot of people thought Trump gets in office, right, takes over, consumer sentiment's going to spike, everybody's going to feel good. We're not seeing it yet, unfortunately. It doesn't mean it can't come, 6 months from now or a year from now or 2 years from now. But the moral of the story is Trump's in office and people are feeling even worse. And so that's definitely, and not a little bit, but like a lot worse. That's definitely a little worrisome, right? Now, additionally, something that could really scare me. This is a 3-month chart I'm showing you right now of DR Horton. That stock's down 19% in the past 3 months. ITB, which is a construction index, down 22+% over the past 3 months. Pulte Homes is down 26% over the past 3 months. KB Homes down about 28% in the past 3 months, and Toll Brothers down 34%. Not good in the past 3 months. By the way, who was buying Toll Brother puts at the end of last year? Should have kept them on a little bit longer though. I didn't get the timing perfect, but we still made a little bit on that those toll puts, right? But the moral of the story is here: if these companies continue to get worse, that worries me. I always tell you guys, like, home building is so important. It's the most important thing, in my opinion, to the overall economy. You see slow home building completely dry up, the economy is going to dry up and it's going to get nasty. If home builders, kind of go through this rough time and then emerge out 3 months from now, 6 months from now, and things start to improve, their stocks start to improve, their orders start to improve, then we can start to feel a little better. But for right now, is definitely a little time you gotta be like, oh shoot, what's going on here? I don't like the way this is setting up, right? But with that being said, we're building a mansion here, and we got to keep building. And so, in regards to your portfolio, keep building, keep buying. If you get great deals out there in the market, take advantage. Like if you own this stock, if you own a basket of 15 stocks, right? And let's say 10 of those stocks are going down because they're worried about tariffs, they're worried about stagflation, they're worried about whatever, and you liked them at the previous price. Why would you not buy it when it's 10% discount, 20% discount, right? And always do remember, every dip's a buy. It's just the truth. That's the best part. There's no debating it. Every dip in the stock market is a buy. Every one of them. Show me one dip in history that was not a buy. I'll wait. There was never one. The Great Depression was a great buying opportunity. The crazy inflation and stagflation you had in the 70s and 80s, great buying opportunity. And the tech bubble, prior to the bubble and during the bubble and after the bubble, great buying opportunity. The great financial crisis, before it, during it, and after it, great buying opportunity. The Rona crash, before it, during it, and after it, great buying opportunity. 2022, before it, during it, and after it, great buying opportunity. And whether we get a crash in the market in 25, 26, whenever, great buying opportunity. Always remember that. And so that's why I was just always focused on building. There's some times I might be buying some puts out there. I see some opportunities for some real hedging, right? Some opportunities I see great time periods to build cash, to redeploy funds from growth stocks into value and divs, or from value and divs to growth. Like let's say a dynamic happens where value and divs go beast mode over the next 12 months, let's say for instance, right? And Estee Lauder skyrockets, and Nike skyrockets, and all these stocks skyrocket. Meanwhile, growth stocks and tech stocks just get obliterated for the next 12 months. You'll see me redeploy money from value and divs at that time and take crazy profits. It's just the name of the game, man, okay?